Hello, I'm Laura McPhee, a reporter at Pensions Insight and Engaged Investor magazine, and I'm here with the economist Philip Coggan. Very good to have you here, Philip.
Nice to be here. It's such a nice, quiet spot.
Well, I wondered if you could start out by telling me kind of what's going on in the markets at the moment and how that affects pension schemes.
It's a fascinating moment for the markets. We've got equity markets reaching new highs, not in Britain with the FTSE 100, but the Dow and the S&P in the US. And generally a buoyant period for equity markets so far this year, particularly in Japan. But at the same time, while the assets are going up, because bond yields are falling, the liabilities are rising as well. So it's not all perfect for pension funds. And that points to a little bit of a mystery as to what's going on. So is it that markets are going up because they think the global economy is recovering? Well, if that's the case, then why are bond yields falling? Because bond yields normally fall when the recovery is faltering. And what role do falling commodity prices play in all this? Because we've had a big fall in gold, we've had falls in other commodity prices. That tends to point to a weak global economy again, and sits out of sync really with equity markets. Now, there are a couple of potential explanations. One is that Japan has recently launched its new round of quantitative easing, trying to push up inflation. And one theory is that the money is flowing out into the world, particularly into bond yields. That's good for the bond yield part of the market, while in the rest of the market, the fact that yields and everything else are so low means that people are very keen to buy equities. And a second sort of cash flow related thing is that companies still have lots of cash and their profits are still going up in the latest numbers in the US. So they're using that cash to buy back their own shares, and that's pushing share prices up. So the result is a mixed bag for pension funds, but it still points to a bigger problem in the longer run. And that bigger problem is the effect of low yields. Are we in a world like Japan has been suffering for the last 20 years, where yields stay very, very low? Because if they do, then liabilities will be high, the cost of funding pensions will be greater. And I think a lot of pension schemes, I've been talking to some pension experts about this week, have sort of been working on the assumption that yields are artificially low, they'll come up again in a few years' time, liabilities will fall, the deficits will disappear, and everything will be hunky-dory. But I think you do have to now consider that we're in a sort of permanent world in which yields are low. And to think about that, think of what would happen if the Bank of England or the Federal Reserve suddenly announced they were going to increase rates to what we might consider more normal levels, 4 or 5%. Well, I think you'd have economic chaos, wouldn't you? You'd have people failing to pay their mortgages, you'd have companies getting in trouble. So it doesn't seem that that's likely to happen for the next few years. So pension funds have got to face this world of very low yields for a very long time.
And so what can pension schemes do to help mitigate some of that risk?
Well, I think the one thing they shouldn't be doing is taking a lot more risk. If you think about what low yields imply, they do imply low growth. So although that low rates might sound attractive for stock markets because they look better than the alternatives, low growth isn't great for stock markets. And if you think that the return on equities is what the return on bonds or treasury bills is, plus a risk premium, let's say 3 or 4% in history, then a low risk-free rate, a low bond or bill rate, means a low absolute return on equities as well. Now, the temptation will be to take a lot more risk and go into private equity or hedge funds to try and offset the low return from equities. But I think that's probably a mistake. First of all, where do hedge funds and private equity get their returns from? Well, in the end, it's got to be some combination of profit growth, which comes back to the economy, or taking risk on credit in the markets. One of those two things. And again, credit yields, credit spreads have come down. Yields are very low. Junk bond yields have fallen below 5% recently. So there's not a lot of extra juice to be got out of there. So they won't be able to magically produce returns. But at the same time, private equity and hedge funds charge high fees, and those high fees will eat into pension fund returns. So they need to be thinking about certainly keeping an exposure to the equity market, but where possible, de-risking as much of their portfolio as possible. So looking to offset the longevity risk they face, the inflation risk that they face, in as many ways as they can.
Well, thank you very much for that, Philip.
Thank you.